Well, today's review is for homework 5, and homework 5 is covering the efficient portfolio. Basically, we're trying to solve for efficient portfolio and to introduce the concept of efficient frontier. So, efficient portfolio is basically a technical concept. So, we're trying to find the portfolio that is mean variance efficient, which means that there's no other portfolio that has higher return and lower risk. So the efficient portfolio is already the one that has been optimized, and that's why we call it efficient. Now, we will start with homework 5, and I will go over each questions, including the Excel questions. Now, number one, diversification is most effective when security returns are high, negatively correlated, positively correlated, and uncorrelated. We have a similar in-class exercise that asking some questions similar to this, that what by adding what type of securities into portfolios, we can have some sort of diversification effect. And then the answer for that question is that as long as the correlation between the portfolio and the newly added stocks is not equal to 1, so the correlation is at least is below 1, then there is some sort of diversification effect. And a correlation equals to 1 means that's the two risky assets are not possibly perfectly correlated. So as long as the securities are not positively correlated, there will be like perfectly positively correlated. There will be some sort of diversification effect. And the diversification effect is going to be most effective when they are negatively correlated. So which means that their movement are cancel out. So one go up, one go down, then the individual risk is therefore cancel out. So if there is some systematic risk out there, then they will move together. So that part cannot be canceled out. So we are trying to achieve diversification such that we can minimize the exposure to firm-specific risk. Next is beta is a measure of security responsiveness to. So beta is a systematic measure, systematic risk measure. So it's going to be market risk. And it's pretty easy to eliminate all other three because all other threes are all talking about the same risk. So firm-specific, diversifiable, and unique risks are all talking about the same type of risk, the risk that is specific to the firm. Now, the risks that are that subject to that everybody has exposure to is called market risk, and cannot be diversified away, and that is what the beta is capturing. Next is on a standard expected return versus standard deviation graph, investor will prefer portfolio that line the current investment opportunity set. Okay, we talk about this. I probably need to put up the slides here. And the graph. Okay, cool. This graph. So this is the graph that plots the standard deviation on the x-axis and the return on the y-axis. And you're going to see that the higher return, lower risk direction is on the northwest side, which is our location. So the northwest of the states. So what is better? What are the better portfolios on this graph? Those are the portfolios on the northwest So the upper left side. And of course, that's what we want. We want the portfolio to be as upper left as possible. But given the available individual assets that are available to us to invest, there is a limitation about the maximums that we can optimize the portfolio. So we can, there is another graph. Yes. So the best we can optimize is this towards this direction. So on this curve, which we called it efficient frontier. Now, any portfolio that is in the inner area of this frontier is not efficient. So therefore, we want the portfolio going towards the upper left direction. So if there is another efficient frontier with more available individual assets that has some curve that is more curving towards the upper left, then that efficient frontier will be even better. So going back to our analysis, it's gonna be lying on the left and above. Next, if an investor does not diversify his portfolio and instead put all of his money in one stocks, the appropriate measure of security risk for that investor is A, stocks standard deviation, B, variance of the market, and C, stocks beta, D, covariance with the market index. So because the portfolio is concentrated in one single stocks, so the one stocks risk will be this investor's total risk. So the risk of one single stocks, the total risk of one single stocks is measured by the stock's standard deviation. So all other three are some measures related to the market. Now, the stocks risk includes firm-specific risk and its systematic risk. And standard deviation captures the total. So firm-specific risk plus market risk. Now, this variance of the market is capturing the total risk of the market. So it's not specific to the stocks. And then stocks beta is capturing the stock systematic risk. So it's just one part of the risk that the stocks has. And then covariance with the market index is a concept similar to the stocks beta. So co-movement with the market. So the capturing the systematic part. So next question, what is the most likely correlation coefficient between a stocks index mutual fund and the S&P 500? So the stocks index mutual fund and the S&P 500, so you know that S&P 500 is usually what we call the market index. And the stock index mutual fund, and we learn it in the class, index mutual fund is also a diversified portfolio that captures the index, that try to mimic the performance of the index. So you have a market, a fund that following the market and the market itself. So the correlation is going to be very likely equals to 1. So they will be very likely positively correlated and perfectly positively correlated, simply because this fund is a fund that trying to follow and mimic the market portfolio, and S&P 500 is the market portfolio. And of course, there could be slightly differences. They may not be perfectly positively correlated. Maybe because the index is a different index. Maybe it's tracking Russell 3000 instead of S&P 500. So then they will be not exactly equals to 1, but it's going to be some numbers that is very close to 1. Next question. You are considering adding a new security to your portfolio to decide whether you should add the security. you need to know the securities A, expected return, 2, standard deviation, 3, correlation with your portfolio. This question is very good. Now, we want to know, and we in the previous question, we know that if we want to know the diversification effect, we have to know the correlation. So this one is number 3 has to be checked. And then and we were only talking about diversification. We're not talking about, how would be this individual securities contribution to the market, to the portfolio's return and the portfolio's risk. So in that sense, we do need to have the individual's return and individual standard deviation to know that its individual contribution towards the portfolio risk and portfolio return. So we need 3 of them. Next question, the efficient frontier represents a set of portfolios that maximize return for a given level of risk. That is the right one already. And minimize return for a given level of risk. We never want to minimize returns for a given level of risk. This is not our goal. It is a suboptimal way of selecting, not an efficient way, not an even rational way of selecting a portfolio. C, maximize risk for a given level of return. We never want to maximize risk. And none of the above options are correct. We found an option that is correct. So if I change this question C to minimize risk for a given level of return, then C will be also a right answer. Question 8. What is the standard deviation of a portfolio of 2 stocks given the following data? Stock A has a standard deviation of 30%. Stock B has a standard deviation of 18%. The portfolio contains 60% of stocks. Of stock A, the correlation between the 2 stocks is -1. And we just need to follow the formula here to calculate the standard deviation. I'm going to use Excel to calculate it. So holding up my Excel here. And minimize it. Find a blank sheet. So it's going to be equals to 0.6, since it has 60% on A. Or let me pull up the weight. So standard deviation of A is 30%. Standard deviation of B is 18%. And we want to have the weight for A is 60%. Weight B is therefore equals to 1 minus 60%, which is 40%. And the correlation is -1. So the standard deviation of the portfolio equals to the weight times standard deviation, raise it to the power of 2, square it, plus weight times standard deviation, raise it to the power of 2, plus 2 times the weight times the weights, the standard deviation times weight times standard deviation times the correlation. And I need to take the square root. So, and measure it in percentage. 10.8. So we're selecting B. All right, next, a portfolio is composed of two stocks, A and B. Stock A has a standard deviation of return of 35. Stock B has a standard deviation of return of 15. The correlation between A and B is 0.45. A composed 40, B 60, and the standard deviation of this portfolio is, okay, so I'm going to just change the number here since the formula is the same as the above formula. So the standard deviation of A turns out to be 35. So I'm changing it to 35. And then here, B standard deviation change it to 15. And stock A has 40% in the portfolio. Stock B has 60%. And the correlation is 0.45. All right, so the standard deviation of the portfolio is therefore 19.8. If I show 2 decimal point, so that's going to be 19.76%. All right, scrolling down, the project has a 50% chance of doubling your investment in 1 year and 50% chance of losing half of your money. What is the expected return of the project? So this is a very simplified scenario analysis. So scenario analysis is something we have done last chapter. So we're using the likelihood 0.5 of losing half, so -50 times 0.5 of doubling. Doubling is 100% return. All right, I'm gonna copy these in Excel. So 25% will be the expected return of the investment. All right, next, the expected return of the portfolio is 8.9% and the risk-free rate is 3.5. If the portfolio standard deviation is 12%, what is the reward to variability ratio? So what is the Sharpe ratio of the portfolio? Now, Sharpe ratio formula is in the slides of chapter 5. So we went through that in chapter 5. In case you want to have the formula, you just need to go back to the slides. So I am able to remember the formula. So Sharpe ratio equals to the portfolio return minus the risk-free rate, 3.5. And that will be, the difference will be the risk premium divided by 12%. It's the standard deviation. And the answer is 0.45. Okay, scroll down. The following figure shows plots of monthly rate of return and the stock market for two stocks. So the x-axis is RM minus RF. RM is the market return. RF is the risk-free rate. So which means that the x-axis represents the scale or represents the return for assessed market return. And the y-axis are RB minus RF. So we have a stock B here, and RB minus RF means that we are capturing the assessed return of stock B. And RA minus RF, we're capturing, for this part, we're capturing the assessed return of stock A. So here, you can see that this is the fitted line is a model that trying to fit the correlation and co-movement between stock A's and market. And the fitted line on the right-hand side trying to model the correlation between stock B's movement and the market movement. And you will see that the stock B moving more. So the stock B, it moves positively. It can move positively related to the market. So when market goes up, stock B also goes up. And for A, when market goes up, stock B does not necessarily goes up like this point here. So market return is high, but stock A's return is not as high. And in this case, market return is low, and stock A's return is it's not necessarily negative. So market return here is negative, but stock A's return is positive. And here, even more positive. So you see that stock B's return more closely related to the market. Stock A's return is less closely related to the market. And that's what we can tell from the graph. So let's see what is asked in the question. So which stocks is riskier to an investor currently holding a diversified portfolio of common stocks? Which stocks is riskier? And this question, which stocks is riskier to an undiversified investor who put all of his fund in only one of these stocks? Which stocks is riskier to an undiversified? So to an investors that is holding a diversified portfolio, which means that a diversified portfolio can basically think it as a market. So for an investor that is holding a market portfolio, so looking at A and B, B is more having a higher correlation with the market. B has a lower correlation with them. B here has a higher correlation with the market. A has a lower correlation with the market. If this investor that holds the market consider B, there won't be any there will be fewer diversification effects. So so B to this investor that has a market portfolio has not much effect out there to diversify its market portfolio. So B towards these investors will be riskier relatively. And then for undiversified investors who put all of his funds in one of these stocks, then we're asking which stock has higher total risk. So we're not just looking at systematic risk out there. The stock B has higher systematic risk. Stock A here has higher total risk. Its firm specific risk is high. Its systematic risk may be low, but its total volatility, its total standard deviation is high. So in terms of a total standard deviation, total risk out there, stock A is riskier to anyone out there. So to anyone that's whose portfolio is undiversified. Okay, so then let's move on to the Excel questions, 13 to 16. So I'm gonna clear this part. Well, first question, consider the performance of a stock fund and a bond fund based on the state of economy. So we have scenarios here. Boom, normal growth, recession, severe recession. So probability listed here, stock funds return listed here, bond funds return listed here. And what is required using the information above? First, calculate mean variance standard deviation of stock bond funds, then discover the covariance and correlation between these two funds. So we will calculate the mean, and looking at the hint here. So the mean calculation is basically based on weighted average, and the weighted average function in Excel is called sum product. So we're entering the weight and the return. And drag the weight to the correct column, enter. And the variance, so variance will be equals to sum. So for the variance, actually we practiced this column by column last week about calculating the variance. So I'm here just to use one single formula instead of calculating this step by step. So one single formula will be summing the probability times return deviation and square it. So this formula, Excel has a very unique way of calculating things. So this return minus the mean means that each row will subtract the average. So first row here, 0.05 minus 6.34 will be the deviation from mean for the first scenario, and 0.07 minus 6.34 will be the deviation of mean for the second scenario under normal growth. So, and etc. is it will calculate the deviation from mean for each row. So there will be 4 number under this difference. And then you use we calculate the square. So we're taking the square of deviation from mean, and then we calculate the product. So using the probability. So in this way, Excel will calculate it row by row. So using the 0.25 times the square deviation from mean, and 0.45 times the square deviation from mean for the second row. And then the sum will be taking the sum of 4 different numbers. So because there are 4 different rows. So that will combine our different steps in different column into one single formula, and that looks more elegant. All right, good. I'm gonna reduce the decimal point. And standard deviation will be the square root of variance. All right, and then correlation and covariance. So for covariance, it equals to sum of probability times the deviation from mean for stock fund times the deviation from mean for bond fund. Enter. And then the correlation equals to covariance divided by standard deviation of stock. I need a bracket here. Times standard deviation of bond. Close the bracket. Correlation doesn't need to measure in percentage. Good. So negatively correlated stock and bond. So that will be the first question. Moving on to question 14. Still scenario analysis. And we are given the mean variance standard deviation correlation covariance here already. And okay, so we want to calculate the mean variance standard deviation of the combined portfolio. We want to combine stock fund 70% and put in 30% in bond fund. So then this will be very similar to a portfolio of two stocks. So we have two risky assets here, stock and bond, equals to the weight times return plus the weight times the next return. So that will be the portfolio return for a portfolio that has stock fund as well as bond fund, and the weight is 7% versus 30%. And the variance is we're using the weight times the standard deviation of stock raised to the power of 2 plus the weight times standard deviation of bond raised to the power of 2 plus 2 times stock weight times standard deviation times bond weight times standard deviation of bond and times the correlation. Then square root of variance equals to 16.23%. All right, so that will be question 14 and question 15. We have the performance of stock fund and bond fund, as well as the risk-free asset treasury bills. We have their means, we have their standard deviation, we have the correlation between stock and bond. And the optimal risky portfolio solve the weight for stock fund and the bond fund and tells us that putting these weights on stock fund and bond fund will give us the optimal risky portfolios out there. And therefore, what do we need to calculate? Calculate the mean, variance, standard deviation, and Sharpe ratio for optimal portfolio. So we want to calculate the mean here, average return for optimal risky portfolio equals to the weight times return. Stock fund plus weight here times the return. You may wonder, why shouldn't we use this? This is some excess return You're not asking to calculate the excess return of the optimal risky portfolio. You're asking to calculate the average return. So that's why we're still using the return of fund, return of bond. Now this 11.5% is exactly 13% minus 1.5% equals to 11.5. 3% minus 1.5 equals to 1.5. So that's excess return. We are not using that number yet. And then variance equals to the weight times standard deviation square plus the weight times standard deviation square plus 2 times this times this times this times 1, 2, 3, 4, and we need a correlation. And standard deviation equals to the square root of variance. Sharpe ratio is gonna be return minus treasury divided by the standard deviation. And I will need to show it in decimal point. Okay, so that will be question 15. All right, the last question. The following table contains assessed monthly returns of 3 companies. Company 1, 2, and 3. In the market index is here. So these are returns. Not in percentage point, but in decimal point. And they are the time series. So this is time series, time series, time series. And if you combine the columns, all the columns together with the rows, this will be called panel data. So you have a panel. And using the monthly assessed return above calculates the stock's covariance with the market and their betas. The covariance of the market with the beta is just its variance. We'll be doing that. So I probably need to show the slides for the beta part. So here is the beta measure. So beta is capturing the exposure to the market. So it's capturing the sensitivity of securities return to market factor. So assuming that there's a market factor out there, market factor is basically the risk of the entire market, and every single security has exposure to that. So if the market doing well, then if you have a high exposure to the market performance, then the individual firm will also do well. If the individual firm has a low exposure to the market performance, a market factor out there. So when market does well, it's not gonna do as well. But a good thing is that when market goes down, then the stocks with low exposure to the market will not be affected as much. So that will be calling us defensive stocks. So then how do we measure the systematic risk? How do we measure beta? So since we know that beta captures the exposure of the company to the market factor or securities responsiveness to the market. So how sensitive is this security to the market movement? So we'll be estimate this model. So this model is basically a linear regression model. So it has an intercept here. E captures the error term, and B here captures the slope. So you're gonna see the graph here. The x-axis is the market return. here. So monthly assessed return market index. The y-axis is Disney's and individual firms' return. And the raw data is shown by this scattered plot. So you have dot, 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 dot here and there, the red dot here. And the fitted model will be the linear line here. This is called a fitted line. It's our model, statistical model for the relationship between individual business return and the market return. So we're trying to use one simple but elegant statistical model to represent the relations between Disney and the market. So it's not, there is error, measurement error here. There is also estimation error, because you see that not every single dot lines on exactly on the fitted line. You see the dot here, which is pretty far away from the fitted line, dot here, here, and here. That's the error term. That will be captured by the error term. And the intercept here captures this point. So when market return equals to 0, there is this fitted line cross the y-axis, and the y-axis value will be the alpha, will be the intercept. And the slope of this fitted line is captured by beta. So you see that if the slope is steeper, and that means that this individual stocks is more sensitive to the market movement. If this slope is flatter, so which means that if, no matter how big the movement for market return is, the individual return, since the slope is flat like this, the individual returns is not gonna be increased by the same amount. It's gonna be less responsive to the market movement. When the slope is higher on this side, the left side, it's more sensitive to the market movement. And you can see that in some rare scenario, you see a negative slope here. These are, if you see negative slope, that basically means that there is negative beta. In theory, there shouldn't be negative beta, because every single company is a part of the economy. So if you think market as the whole economy, so then every single piece, every single firm has a share in it. But statistically, when you look at the real data, there's always some rare scenarios out there. In these rare scenarios, therefore, you can actually look at the data and find firms that are negatively correlated with the market. So it's basically a statistical relations here. You see that when market goes up, this individual stocks goes down. So it has negative relations with the market, negatively correlated. So that will be beta in theory. What does it mean? And then we will just use Excel to empirically estimate this model and empirically estimates the beta. So go to Excel here. So we want to calculate covariance with market as well as beta for each individual stock. Covariance is simply, you can simply use the covariance function in Excel, and firm return, comma, market return. I think this is trying to say return. All right, so then I can scroll it down and change column. Change it to the second stock. and enter. Change it to the third stock, enter. Change it to the market, enter. And then for beta, you can use the slope function. The y, we're basically estimating this linear model. So y will be the individual's stock return, x will be the market return. And x will be the market return. So let me test another way of calculating it. So I'm gonna calculate the way that following the hint. So using covariance divided by the market variance. Second one, covariance divided by the market variance. Covariance divided, no here. Covariance divided by the market variance. And you see that they are exactly the same. So the two methods will give you the same answer. All right, so that will be it for homework 5.